everyone, Alex Ong here from Traders Corner, and in this video we're going to talk to you a little bit about our day trading system. This is a system that we use every day to profit trading the Forex markets, and as I said in this video we're going to give you the basics of that system, so hopefully you can take something away and incorporate it into your own trading system to be able to make money trading the markets as well. Now, before we get started and get into the nitty-gritty of the system, just want to talk to you a little bit about the charts that we use, because they're not your conventional time-based charts you see on MetaTrader or something like that. What we're actually using is something called a range bar. Okay, now range bars were created in the 90s by a Brazilian broker, and ultimately the reason that this guy created this particular chart was because the Brazilian markets were very, very volatile. And what essentially he was looking to do was eliminate the market noise from the equation, because it was so volatile, it's always very up and down, it's very difficult to trade, and he wanted to take the noise out of that, and ultimately decided that taking time out of the equation was probably the best way, and just focusing on price. Because at the end of the day, over all of the forums, all over the internet, you're going to see people saying things like, you know, the thing that changed my trading was learning to trade price action and all of that kind of good stuff. So why not actually just trade a chart that's based purely on price and not really take much of the time aspect into the equation at all? And that's essentially what he's done and what we do with our trading now. Okay, so a range chart is a chart where the candles are of equal distance from high to low. Okay, so the range from high to low is always going to be a predefined range. Now, we personally, on the day trading basis, we trade an 8 range chart, which means that every bar or every candle on that chart is 8 pips from high to low. Okay, but obviously you can decide whichever one works best for you. It's just us personally, we use the 8 range chart. So the charts we use have candles where they're equal distance from the high to the low. Okay, we're not talking about a range bound market or anything like that. We're very much trend traders and swing traders, so we always like to trade in the direction of the trend. The only difference is we're not using time-based candles, we're using range candles. Okay, and the reason that we do that is it allows us to focus on a cleaner chart. Okay, and that makes entries a lot easier to spot. So whereas with time-based charts you may not be able to find an entry, and actually yesterday was a very, very good example. On the back of the ECB press conference, there was a lot of volatility in the markets and there was a lot of movement there. Now, if you looked at something like a 5-minute chart or a 15-minute chart, there literally was there wasn't an opportunity to get in there to trade that price action. However, trading the range chart, we had 3 or 4 really, really good opportunities to get into the markets and sell into the move that was unfolding before us, and obviously we're able to profit from that. Okay, so as I said, the reason that we use range charts is it allows us to focus on a cleaner chart, and hence it makes entries easier to spot. Now in front of you, you have a range chart, and I just wanted to give you this quick image here before we get into the nitty-gritty of the system, just to show you what it looks like. And later on in this video, I will show you the difference between a range chart and a time-based chart, but this is just to give you a little bit up front to show you how clean the price action can be. So if you look on the chart there, you'll see that we're clearly in a down move, okay? But whereas if you're looking at a time-based chart, you wouldn't necessarily see these little pullbacks in price actions, because some of these would be contained in one single candle. Okay, on the range chart, you can see that there are very many entries there in front of you, and you know, a lot of opportunities to be had. So what's the difference between a range chart and a time-based chart? Okay, like why do we like range charts? Well, let's start off by looking at the time-based charts. The conventional FX generally trade time-based charts, okay, because there isn't really much need there for something like a volume chart, because there isn't any central exchange, so that doesn't really make much sense to me. And obviously, if you look at all of the standard charting platforms, they use time-based charts. Okay, so if you look at something like MetaTrader, you'll see that you can trade a 1-minute chart, a 5-minute chart, 15-minute chart, you know, an hour chart, 4-hour chart, you name it, whatever sort of time you're looking for, you can probably trade it. Now, what's the problem with a time-based chart? Well, first of all, during periods of, you know, quiet periods like the Asian sessions, bars print without price having to do all that much. Okay, so nothing significant needs to happen for a new candle to be printed. All right, it's just because, you know, it goes from, if you're on a 5-minute chart, it will go from, you know, 4 minutes and 59 seconds to 5 minutes, and suddenly a new bar's been printed. And that is really sort of what makes the chart start to look untidy, because there hasn't really been much difference in price. Nothing's happened in the market, but a new bar's been printed. So you've got all of this sort of noise there with no real information or tradable information on a day trading basis from my personal perspective. Okay, so that's really the biggest problem there. And obviously with that problem comes the issue with your indicators. Your indicators also tend to get a little bit skewed. And the reason for that, again, is that they start to look at, you know, times like the Asian session as times where of low volatility, which is true, but it's low volatility not because of the price action. It's low volatility because nothing happens. There's no volume in the market then. So that can also sort of cause your indicators to get a little bit out of whack and give you some false signals here and there. Okay, so that's a time-based chart. With a range chart, each bar is exactly X pips from high to low. Now I said to you that, you know, with our charts, we're looking for 8 ranges. So it's 8 pips from high to low for our particular charts, but you could use a 10 range, 20 range, 40 range, whatever it is that you're comfortable with. You can create a price action based chart according to that criteria. Now, the benefit of this is if the market is consolidating, you're not going to see many bars printed. Okay, so you're not going to get that noise there with your trading. You're not going to have all of these bars with sort of like wicks, long wicks here and there, and just nothing much happening, because ultimately with a range chart, a new bar is only printed when the predefined range is exceeded. And by definition, if the predefined range has been exceeded, then there's been some movement in price. Do you see what I mean? Whereas with a time-based chart, price doesn't really need to move that much, and a new bar or a new candle will be printed. And as a result of this, we're able to eliminate a lot of the market noise. Okay, so by definition, if the range chart only prints once the range has been exceeded, we're only going to see new candles created when the market is moving, which eliminates the market noise and allows us to identify trading markets really, really well. Okay, and obviously if we're able to identify a trending condition, then this allows us to make very good entries in the direction of the trend, which is the primary way that we make money trading the Forex markets. Okay, so is that clear to you guys? All right, a time-based chart, bars are printed just arbitrarily, so for no particular reason, just because we've gone from one period in time to a next period in time, whereas range bar charts are based purely on price action. So this is the difference of what a range candle would look like to what a time-based candle would look like. Now, if you can, as you can see here in front of you, the time-based candle, the high and the low don't necessarily coincide with the open and the close. Okay, now that would make sense because that doesn't have to happen. Whereas with the range-based candle, the high or the low is always going to coincide with the close of the candle. So the candle, so you can get wicks on these candles, but they're not going to be long, ugly wicks that you can see on the time-based charts. The close of the candle is always going to be at the extreme of one of the candles. Whereas with a time-based candles, you can have the wick either side, because the close doesn't have to occur at the extreme of the candle. The close occurs because, as I said, an arbitrary moment in time has passed and a new candle is created. So let's take a look at some examples of different range charts, just so you can see the difference here. This is the Asian session for a 5-minute chart. Okay, you've got a 5-minute chart in front of you for the Asian session. As you can see, it's very range bound, it's consolidating, it's not really doing all that much, and the price action is generally quite ugly. If we now move along to an 8 range chart, this is for the same period in time. Now look at how much cleaner that price action is. Okay, so if you were trading this session, you could decide to trade the very identifiable high and low of that particular range if you wanted to trade that way. We personally wouldn't do that because we trade in the direction of the trend. But if you wanted to range trade, you can see that there are many opportunities there to sell the top of the range and buy the bottom of the range, because it's very clearly identifiable and it allows you to find the entries very easily. Does that make sense to you guys? Looking at the 5-minute chart on a day trading session. Now, of course, there are a few entries here that I can see that you can take. You know, there's at least 2 or 3 entries that you'd be able to take in a trending market to make money on this particular chart here. But what about the 8 range chart? Now look at how much cleaner that chart is, and look at how many more opportunities there are on that chart. I can count 1, 2, 3, 4, 5, 6 opportunities on that chart, whereas on the previous chart we only had sort of 3 and 4. Now those 6 opportunities, they wouldn't necessarily all have made you money. 5 certainly would have, but the 6th one would have probably ended up stopping you out. But that's not the point. The point is that entries are a lot easier to see trading the range charts. But what about from a longer term perspective? Well, looking at this chart here, you've got the 4-hour chart in front of you. Now, again, this market is moving in a particular direction, so it would be wrong to say that you couldn't trade it. Yes, indeed, you could trade this chart and you could trade it profitably. But let's take a look at the difference by looking at sort of like the equivalent range chart. Now, look at the pullbacks in this price action here. This is a lot cleaner and from my personal perspective and a lot easier to trade. Okay, so now that I've shown you the difference between the different charts, a time-based chart and a range chart, and hopefully you're on board there with me, understanding that a range-based chart is a lot nicer in terms of, you know, aesthetically pleasing trends and easily identifiable opportunities. Now, if you're sort of on board there, let's talk about the system and the way that we trade these charts. Now, first of all, for an overview of the system, well, it's a swing trading system. Okay, so as I said, we like to trade in the direction of the trend, and we're looking to exploit the little swings whilst the trend is in motion. It's price action based. Obviously, it's a range chart, so we aren't really looking at time. We're purely looking at price action here. We're always looking for a positive risk reward. Okay, now that's sort of the basis for all of our trading, because we like to know that we don't even have to be right 50% of the time and we can still make money. So our system is price action based. It's always looking for a positive risk reward. It is very fast paced. Okay, so this system, or the day trading part of it anyway, is very fast paced, and it is one of those systems where you have to be in front of your screen and sort of ready to execute when you get the particular setup or when you get the signal. Okay, so it's not one of those systems where you can roll up to your screen first thing in the morning, put on a trade and disappear. All right, for the day trading aspect of it, you have to be in front of your screen to execute the trade and to manage your trade. Whereas the longer term perspective, if you went for a larger range, like a 50 range or something like that, then yes, you can set the trade and you can walk away and leave it to do what it's going to do. But for this system here, or for this video here, we're focusing primarily on the day trading aspect of it. We also focus on just one pair. Now, why do we do this? There's a few reasons. First of all, the cost of doing business is less because we trade the euro dollar, and typically we get extremely low spreads on the euro dollar. So our cost of doing business is low. We also take out the ability to overtrade. Okay, so we take out the aspect of looking at loads and loads of charts and looking for millions of different trades. And what tends to happen when you do that is you're always getting in on the wrong trade. So you'll be in on one trade and the other market is moving, this one isn't moving, this may stop you out, then you jump onto the other market, you chase that for a while, then the other one's moving, and it's not a great place to be in if you're looking to trade. And if you want to be successful at this, you need to have discipline. And the best way that we found that you can do that is to focus on just the one pair. And if on certain days you don't get any trades, in c'est la vie, so be it, you don't get a trade. On average though, this system produces about 2 trades a day, between 1 and 2 trades a day. Some days there are less, so some days you may get no trades, some days you may get 3 or 4 trades. But over the course of a month or a period of months, you're looking at, on average, about 2 trades a day. We never carry a position overnight, which is nice for some people to hear because they don't like holding positions, you know, overnight because they don't know what could happen. So we never carry a position overnight for the day trading. And the system is almost purely mechanical. Yes, you have to read the price action. You need to look for momentum in the markets, but the entries and exits are very, very mechanical. You're either in or you're out, and nothing else is left up for debate, which is something that we found that a lot of our members were looking for. And that's why we sort of put this into place, because it's okay being able to read price action, but you need to eliminate that element of doubt from your trading in order to be successful. And we think that we've done that with this system. So the trading times that we trade are 8 a.m. in the morning UK time to 11 a.m. All right, that's the morning session. And then we trade the UK-US overlap at 1 p.m. to 4 p.m. UK time. So any trades that occur before or after those times, we don't take them. Even if we get a signal, we do not take them. All right. Now this is because we have back tested this. We've gone back over, you know, many hundreds and thousands of trades, and it's just shown us that these tend to be the most profitable times of trading because they are the most volatile times. Now about the basic entry rules. Now first of all, before I talk about the basic entry rules, I need to make you aware that this is a very short video, so we are limited for time, and for that reason I can't give you all of the filters that we use for entering the markets or filtering out the bad trades. But what I can do and what I will do here is just give you the basics of the system, then you can go away, take a look for yourself, and then if you're interested in learning more about the system, come back to us, drop us an email, and we'll take things from there. So the basic rules of the system are: the market must be trending. Okay, the market must be moving with momentum in a particular direction. We're not looking to enter on, range-bound markets or choppy markets. So the markets must be trending in a particular direction. Once the markets are trending, we're looking for pullbacks to previous areas of support or resistance. Now this is very important. We don't just take a trade anywhere on the chart. The price must pull back to a predefined level of support or resistance, a place where we're expecting the price to turn around. Okay, once the market's pulled back to that level and we've identified that level, the market should start to bounce off of the predefined level. Now the reason for this is that we don't have a crystal ball. Okay, none of us are fortune tellers, and we don't know what the markets are going to do next. So we don't just buy or sell from a level because the price is pulling back to that level. We need to allow the price to prove to us that that level holds some sort of significance, and hence we need to see some sort of a bounce from that level. The setup candle, so the candle that bounces off of that level, must obviously close in the direction of the trend. If it doesn't close in the direction of the trend, then it isn't bouncing by definition. Okay, so the setup candle must close in the direction of the trend. And you must have at least 1-to-1 risk reward, including the spread, before the next support or resistance level. Now, support and resistance levels can be trend lines, horizontal support and resistance lines, pivot levels, whatever it is that you like to look at as a support or resistance level, that's fine. But you must have at least 1-to-1 risk reward on the table, including the spread, before the next area that could cause you issues. That just allows your trade to build up a little bit of momentum before it gets to that level to help it push through it. If you don't have that momentum, then it's unlikely it's going to break the level. Now, I hope that makes sense. And finally, you enter on the open of the candle where the above conditions are true. Okay, so ultimately, where I said the setup candle must close in the direction of the trend, as soon as that candle is closed and the next one is open, you need to be in there. You need to be entering your trade on the open of that candle. The exit rules: the stop must be behind the setup candle. Now, if you're day trading and you're using an 8 range chart, then the stop is approximately 10 to 12 pips on a broker with sort of like a 1 pip spread. Your profit target is always 2 times your risk. So if you've got a 10 pip stop, you're looking for a 20 pip profit target. And finally, we'll wrap up the video by showing you a few examples of some entries. So first of all, we have the long entry. Now, as you can see there, the green line is the signal candle. So after the green line that you can see there, the green vertical line, the next candle along is the one that you would enter. Okay, so the green line is a signal candle. The green line is the candle which is bouncing off of the predefined level of resistance over there, which has now become support. So the blue level, you can see that there's resistance along that level there. The market pulls back to that level, acts as support. The green line is our signal to enter. So we enter on the close of that candle, on the open of the very next candle. And as you can see there was plenty of room there to get our profit off the table before we got to the next resistance point. The next entry is a short entry, okay, and it's ultimately a carbon copy of the long entry. These are the sorts of trades you need to be looking for, guys. If you can find these trades, then you're going to be profitable in the long run. All right, these are the trades you want. The trades where you've got momentum in the market's moved through a resistance or a support area, and then it's come back to it and it started to show respect for that level. And that's exactly what we have here. So the market's trending downwards, as you can see there. It's broken through the support level. Once it breaks through the support level, it then pulls back to that support level and it starts to treat it as resistance. We then get the bounce from that level. Once we get the bounce off of that level, we're in there on the close of the candle of that green line there in front of you. So as you can see, the green line is our signal candle. That's the one that's confirming the bounce. As soon as that candle closes, we're in on the open of the next candle. And again, you can see there's plenty of opportunity there to take your profit off the table before you get to the next support point. And in a nutshell, guys, that is our trading. That's how we go about trading the markets every single day. I'm sorry that the videos had to be a little bit short and we've had to sort of bombard you with all of this information, but unfortunately we only have a certain amount of time to be able to put this together. We're allocated around 20 to 25 minutes for these videos, so I'm going to wrap it up here. Say thank you very much for watching. If you're interested in learning more about the system, then please contact us. You can visit our website at www.traderscorner-online.com. Or you can find us on Facebook or Twitter or anything like that. We look forward to seeing you soon. I hope you've enjoyed the video. Take care now and good trading.